Have you ever wondered how your paycheck gets taxed and then where that tax money goes? Well, let's break it down. For those of you who don't know, I am Professor Nance, and this is lesson 5 of our personal accounting course.
And so I made this little diagram here that basically shows us all of the calculations that we need in order to understand the basics of our tax equation. And so really, we think of taxes in terms of our tax return that happens at the end of the year. But before we get there, let's talk about our paycheck, which also has some direct connections to our tax return. So the calculation for your paycheck is you have your gross income. So your gross income is the gross amount that you make. So if you make $100,000, to make it, let's just pretend like you make $10,000 a month. So if you make $10,000 a month, that's your gross income. Before you get to the part where you get to actually deposit this money into your account, you have to go through a few steps. So you start with your $10,000. You deduct your pre-tax deductions, which are things like 401k and your medical deductions, anything that is deducted pre-tax, which is usually what you want. And then once you subtract that out, you get your taxable income. This is the amount that your tax rate is applied to here. From there, you're going to subtract your federal taxes, which varies per person. And this is very heavily based off of whatever you fill out on your W-4, usually when you start a new job, but you can go back and change it. And we'll talk about that in the next lesson. So you subtract your federal taxes, your FICA taxes, which is 7.65% for everyone. Then you have some state and local taxes, if applicable. So I live in Texas. Texas does not have state taxes, so this would not apply for any of us Texas folks. And then you have any other deductions, you're going to subtract those. So that can be things like child support or student loan garnishments that are coming out after taxes. Once you get to the bottom, you're going to get your net pay, which is the amount that is deducted into your bank account. And that pretty much is the calculation for your paycheck each month. You're probably used to seeing this. At least you know that the gross starts off at one amount and then it ends up at a different amount. But this is all of the things that are happening in between. In an ideal world, you want to maximize your pre-tax deductions so you don't have to pay taxes on them. And then most of this stuff is unavoidable, but you can change this number depending on other factors that we'll discuss in the future. All right, so now let's hop over here to your tax return. When people think about calculating taxes, this is usually what they think about. So this is the formula for your tax return. You're going to once again start with your gross income. Now for your tax return, you're looking at this on an annual basis. So remember, it's tax season now, so you're completing your tax return for the year of 2024. All right, so you have your gross income, which if you remember, we start off with gross income on our paycheck. You have pre-tax deductions, which is the same on our paycheck, except what this means is different from our paycheck. So with our pre-tax deductions, you're probably used to a little something called standard deduction or itemized deductions. So basically the way that the tax calculation works is you get either one. If your itemized deductions are higher than your standard deduction or the standard deduction, then you're going to take the itemized. If you don't have like a home or you don't have things that would help you get a higher itemized deductions, then you automatically will get the standard deduction. What that does is reduce your gross income. So remember that $100,000 that I said you made with the standard deduction, it automatically puts you at maybe like $80,000. So instead of having to pay taxes on $100,000, you pay taxes on $80,000. So itemized deductions are can be things like mortgage interest, student loan interest, donations, so charitable donations to a 501c3, medical expenses, and blah, blah, blah. And then there are other types of deductions as well, like retirement payments that you make and health premiums. We're not going to get too deep into that, but I wanted you to know what all goes into this pre-tax number. So you take your gross income, your pre-tax, and that once again is your taxable income, the same as your paycheck. All right, and then at this stage, we are then applying our tax rate, and the tax rate is going to be based on this number here, this what we call adjusted gross income number. Depending on the tax table and where you fall, if you're filing single, if you're filing head of household, or if you're filing married, filing jointly, that tax rate and the amount of it will differ. So at this point in the calculation, what you're going to do is you're going to multiply your taxable income by that rate, and that's the number that we're going forward with. So previously we didn't actually use the rate, the rate was just used to do the calculation, but over here here, you're going to multiply your adjusted gross income by that rate, and that's going to give you the tax amount that you owe the government. Now, remember, and you can see this little line here, we've been paying federal taxes all along. So what's going to happen is all of that money that you've banked from each of your paychecks is then going to come over here to reduce your taxes owed. So you're going to have your taxes owed minus the taxes that you've paid during the year to get the updated amount of taxes that you owe, which could be, at this point, it could be the amount that's refunded or due to you. So you have that amount here, and then the very last step is you're going to deduct any tax credits, and tax credits can be things like the child tax credit, earned income credit. There are a couple of college credits, energy credits, and then so on and so forth. So you're going to subtract those here, and then you're finally going to arrive to your bottom number, which is hopefully the amount of taxes to be refunded to you, or it could be the amount of taxes owed. Now, just something to remember is deductions in this set of equation. Deductions lower your taxable income, but they're considered above the line. This is the line, the taxable income. They're considered above the line, whereas credits lower your tax bill directly. So credit are dollar for dollar. So it will reduce your tax liability dollar for dollar, whereas a deduction will just bring this number down. So the calculation is just a little bit less of how much you have to pay, but it's not dollar for dollar. So if you have a deduction of $1,000, instead of having to pay taxes on $80,000, you pay taxes on $79,000. But so it's not dollar for dollar. Whereas down here, if you have a tax credit of $1,000 and you owe $2,000, then you now owe $1,000 because you take the $2,000 minus $1,000 to get to $1,000.
So that's it for the basic tax calculation breakdown. And so, as you know, we did not go into detail about business taxes versus personal taxes. That was a very basic overview. In lesson 2, we will go a little bit further into how to maximize your tax experience and some things that you can do to try to minimize the amount of taxes that you have to pay. But for now, I want to know, has this been helpful? And if so, what's one thing that you're taking away from this video? And if I missed anything, then what is something that you would like to see me cover in the next video? All right, see y'all soon. Bye.